for tuning into Talking Point. I'm your host, Niraj Shah. And I want to start the show with something that Uday Kotak put out on the social media platform X yesterday, wherein he spoke about how, because of the inflation print that has come out, rate cuts get pushed to the very least at November, globally, including India. Maybe they coincide with the US elections, which makes the whole piece very, very interesting, if you will. I'm not saying it verbatim, but that's the implication of that tweet. And I reckon that he mentioned that get ready for global turbulence. And now, it's pertinent because that is what seemingly is happening over the last 48 hours. Geopolitics, crude, equity markets being very choppy, and gold, a lead indicator of what the safety prognosis of the investing world might be, knocking on new highs yet again. Somebody who is best placed to correlate all of this and bring the Indian context as well is Devina Mehra, founder and chairperson and MD of First Global. And it's absolute delight to have Devina in our studios. Devina, thanks so much for being here.
Thank you, Niraj, for having me.
No, the pleasure is entirely ours, I must say. Devina, I just wonder though, would investors by and large have a fairly pleasurable next few months, or are there clouds on the horizon?
So you're talking globally or India?
Globally. Let's start with global. I would love to talk global with you first.
Right. So globally, I'm quite positive on the equity side. I was a little more nervous middle of last year when the entire move was very, very tech-led. If you look at US, for instance, from January to October 2023, not just a NASDAQ, which is anyway a tech index, S&P 90% of the move was only 7 stocks, 89% to be exact. And most companies, most stocks underperformed. I mean, they were, I think, something like 70% which were down. So it was very, very skewed. So it's always scary when the markets are that narrow. But thereafter, they started to broaden, and which is playing out, and which is actually good for our strategy, which is a diversified strategy. And now the small and mid-cap indices in the US are actually beginning to look pretty good. So not just the US, there are other pockets. I mean, last year, for example, in the beginning, we were tracking Japan for a turn, and which happened. So last April onwards, for a year now, we've been overweight Japan, Taiwan. So there have been pockets. India also, we think, will be over a period of time in the outperforming bucket, even though we see some shorter term volatility. So that's broadly where we see things. In terms of, you were talking about the Fed. Now, I have never been in that basket, which has actually been the consensus that rate cuts would happen soon. So if you go back to beginning of 23, people were thinking that there would be rate cuts in 23 itself, which I always said are not going to happen. This year at the beginning, it was that rate cuts will begin in March, which again, I never believed. Because you look at it historically, every time inflation is this high, it takes years, not months or quarters to come down. So it was very clear that before 2025, it's not going to happen. And if you look at the print this time, of course, what the Fed tracks is what they call non-shelter services. So that has been that has come up ahead of expectations. Again, not unexpected, because services, if you think about it, have a large labor component, and the labor market in the US has never been anything other than buoyant. So obviously, that part is not coming down. Now, of course, since the commodities are going up, that's an additional push to inflation, because you got that low-hanging fruit in the beginning because the commodities prices had come down. So those are the things which will push inflation. And while the Fed might look at core inflation, which is excluding food and fuel, you talked of the elections. For the politicians, food and fuel is relevant, both here and in the US, because for the consumer, food and fuel is relevant. It may not be amenable to a change in the Fed rate, but still, you can't ignore it.
Yeah. It leads to changes in governments for sure.
Yeah.
Okay, so Devina, how there is this train of thought which also says that look at the US Fed or look at the US balance sheet and how indebted it is, and therefore how can such a nation live with such high interest rates, and some point of time that compulsion as opposed to inflation management will take center stage. You agree?
I mean, first of all, it is the debt is in their own currency, which is something not every nation in the world has.
Enjoys, yeah.
And the debt has been there. I mean, this debt question has been there forever. So again, what happens in the market is what drives the narratives rather than the other way around. So, like I gave an example in a tweet a few days ago, that if the markets go up, you will say that growth is great and that's why markets are going up. If they go down, it might be that the growth is great and therefore the Fed rate cut won't come. So you will have an explanation either way. There's a book called Everything is Obvious Once You Know the Answer. So the narratives we try to fit is often that. So if you go back to, let's say, 2003 to 7, the emerging markets went up 3.5, 4 times. India went up 6, 7 times. But that time, because the US was not doing well, it had not come out of, even after post the tech crash, it took it years to come back. NASDAQ did not take out its 2000 high till 2015 in a sustained basis. So it was like US is over. Now it is a century of India and China. That's when BRICS was coined. And once the US started to outperform again, all that was forgotten. So, every time something happens, you have a narrative that US card story is over, that, de-dollarization will happen, this will happen, all that will happen. But, that's not something I buy into.
So if rate cuts are not a necessity in 2024, yeah.
I'm not saying that they won't happen at all in
you think they might happen?
But I'm saying just it might get pushed
out.
And also, I can't say for sure sitting here today, because the Fed also doesn't know for sure, because all central banks are now very data driven.
Sure.
There have been banks which cut rates and again raised them. 2, 3 of them did that. So that also happens. So now the central banks don't even go by what they said last time. I mean, they really say that forget about what we said. Now this is the data and this is what we are doing.
Look at what we do, don't look at what we say. Okay, great. But let's assume that if there is a period of delayed rate cuts, or maybe at the end of December when we are having this conversation, maybe there are no rate cuts that have happened.
Right.
How would you think global equity markets behave in such a scenario? Because we have geopolitics, we have higher crude prices, and of course, crude notwithstanding, just the higher rates and low growth, presumably, unless growth, of course, picks up, China, others notwithstanding. How do equity markets behave then?
So growth is not that bad as expected. In fact, that's the reason inflation remains high. I mean, that's what I said, that you can pick up whichever side of the equation you want and explain what's happening in the market.
Agreed.
So growth has not been bad, and I don't think our scenarios are that growth is crashing anytime soon. China, you mentioned, if you look at China, again, markets and growth, economic growth are two different things. China's high was in 2007. The GDP is up 7 times since, but it is where it is. So that's the biggest poster child for you cannot draw a one-to-one
correlation
between the macro and what happens in the markets.
Okay, so then what happens to equity markets from now on until whenever the rate cuts happen?
So, I mean, as I said, I'm quite positive still on the global equity markets, and US also is looking fine now as against last year when it was giving me a bit of the jitters. And the other markets, we continue to like Japan, we'll continue to like Taiwan, we like a couple of the European markets more. And as I said, India also from a 1-year perspective looks good, may not be necessarily from a 2-month perspective.
What is bothering you about the 2-month perspective?
Only that there might be volatility. I think up till the election you might see volatility, but it is, I'm just saying that maybe we haven't taken that call yet whether to be hedged or not, but we're definitely not making a cash call. So, there is still a risk of missing out on the up move. So, when there is a little bit of a risk of volatility, we'd rather hedge than be out of the market, because as I always say that there is a risk to being invested in the market, but there's also a risk to not being invested.
Yeah.
So because you might miss out on an up move. So
What could lead to this? Would it idiosyncratic growth related factors lead to India up, or would India be a part of a rising tide globally carrying all boats higher from where they are right now?
No, I think India will be an outperformer, as I said, on a 1-year basis. So it is more to do with the history of India. If you look at equity markets, we all know this 15-16% compounding is what happened from the time Sensex started, and that's what we hope for or what we plan for. But there was a whole decade, 2010 to 20, when the compounding was only 8.8%, which is just trifle above the FD rates of that time. The fixed deposits used to be close to 8% those days. So you got no return, equity returns. In dollar terms, there was hardly any compounding for that entire decade. I think 0% or 2%, something like that. So that is what created the room. So even now, if you look at the mainstream indices, you are not above the trend line. The risk of a big crash comes when you're way above the trend line. You're still not even at the trend line. So that's why, as I said, the risk of being out of the market is more than being invested. But of course, there are the frothy areas, and there are the micro caps and SME and very small caps. So those things are where you should be careful.
Okay. I'll probe that in a moment on the other side of the break, but just one quick question. There's so many people who are skeptical currently on the markets who bring out some signposts that have been used for a while. Okay, पानवाला भी जब बोलता है कि stock खरीदना चाहिए तो it's a caution. Look at the valuations at the small cap and something that you referred to. Look at the fact that promoter बेच रहा है, ये बेच रहा है, PE बेच रहा है, खरीद रहा कौन? Retail investor खरीद रहा है. All of these are telltale signs that the markets will correct. You don't agree?
So as I said, that you have to look at the market on a two-tier basis, that what is the mainstream indices, the large cap and more stable companies, and you have to look at the frothy end of the market. And I often say people who have come into the markets in the last 2 years think that small caps always do well, or they do. But if you look at the small cap index itself, went down nearly 80% in 2008-9, 78% to be exact. It took out that high in 2016, which is also a theoretical high, because by that time the index was completely different. You had this mad bull run in small caps, if you remember, another year and a half, and then 2018, one more crash, almost 2/3. And I said, don't forget your high school mathematics or even your primary school arithmetic, that if something falls 2/3, it will triple and you are at zero. So all the micro cap managers who are now saying 50%, 60% compounding for 2 years or 3 years, but the same people who had brought you down to near zero or down 90%, and from there, even with that 50% compounding, you are still not back to 100. So small caps, those are the risks, and unlike large caps, you can't manage risk in a small cap with a stop loss or something, because when those stocks fall, there is no exit.
India is not top of the pecking order, I reckon.
Not right now, as I said, just because I expect some volatility till the elections are over.
But on a one-year basis, India would be amongst there?
Yes, India is in the outperform basket. Okay.
Yeah. Now, would it be earnings growth that will drive that? Because with valuations where they are not outlandishly high, but they are high.
Right.
So would earnings growth complement this, or would you believe that there could be a further up move of the multiples, or a combination of both?
It would probably be a combination. I mean, again, if depends also partly on commodity prices. If the commodity prices remain high, then that hurts the margins. And one of the, of course, if you look at the macroeconomic situation, you look at the consumption growth, that has not been high. So that's while the headline GDP number looks very good, there's really a single engine, which is the government expenditure, which is driving that. And consumption expenditure is at a 21-year kind of low. So last time it was this low was 2002-03. So last print I saw for consumption was less than 3% growth. So large parts of the economy are hurting. So consumption themes which want to go below the affluent consumer, there is an issue, because as you would have seen all the inequality report, that inequality has been increasing. So the plus, of course, if you're looking at a purely market point of view, is that the listed companies cater more to the affluent customer, and therefore it may not be bad for them, but still, I mean, there are some which cater to the whole market. So that becomes the issue. And if you look at, for example, real estate, I mean, not that we are positive on real estate, but just as an example, that real estate, the listed companies, if you look at, they will be dealing only with the affluent customer, not with, so it doesn't matter if real estate in general is doing well or not. And so those are the things. So in terms of what we like so you have to choose carefully again, it's not market multiples. I am a little skeptical in talking always. I mean, this is not now, for like 30 years, whenever people ask me what's the Nifty earnings growth, for example, So that gets skewed by 2-3 large companies, and there are like all kinds of things. If you look at the Nifty itself, if you look at the sectoral breakup, it has changed so much over the years. At one point of banks and financials were at 0 or near 0. Now that's the largest chunk, for example. If you look at IT services, they used to be much higher. Now they are lower. Something else, PSUs, people who are been in the market only 5-7 years don't know this, but the mainstream indices at one point had so many PSUs, BHEL, VSNL, MTNL, ONGC, Indian Oil, HPCL, BPCL, and then there came a time when people forgot that PSUs exist. So the composition changes. So it's very difficult to just do a PE comparison, or even just look at the entire Nifty earnings growth. So you really have to drill down, because you are not buying that, you're buying something else. So you have to decide on the sectors and the companies which you have to choose carefully.
Got it. Okay. So did I hear you say you're not constructive? Sorry, I'm starting with the micro thing, but I picked it up from your answer. Yeah. Not constructive real estate.
Real estate, it's not that, it is just that it's a high risk sector. So we always manage for risk first. So we are always, as I repeat often enough, investing is a loser's game. So you win if you don't lose. So the first rule is not to take high risk with somebody else's hard-earned money. So that's the first thing we manage for. So that's, we always manage for not just the returns, but returns versus volatility, returns versus drawdowns. So the return should come with low blood pressure, not high blood pressure.
Yeah, and the rule number 2, as Warren Buffett says, don't forget rule number 1. So that's interesting. Okay, yeah, I just thought Devina Mehra often says that, well, when I say that in God we trust, everybody must bring data, Devina says even God must bring data. I thought the data around real estate looked okay, but I get your point, the nature of the beast. So what enthuses you? There is very starkly divided opinion amongst the heavyweight sectors, particularly information technology. So can I start off with that? It's pertinent today.
Yeah, so IT, I think some time this year it will bottom out and will give a buy signal. That's what my guess is. We are not overweight yet, but we are not, we are up, I think, around market weight, maybe 1% less or something like that. So, but that's not a sector that, like a lot of others, kind of wrote off that sector. I don't think that's the case. It's still a fairly predictable sector. And again, the narratives change, that 2022, people, when IT had started underperforming, at that time the logic was that the whole world is digitizing. Even non-tech companies are becoming tech companies. There's so much demand for technology, so much demand for technology people, that these guys will never get the people they want, or the salaries will go up, margins will get squeezed. Now it has become that, this is a pathetic sector and there'll be no demand ever. So those are, and people don't even realize that you're giving two exactly opposite narratives a year and a half apart for the same phenomena.
True.
So,
which is a multi-year phenomenon also.
Yeah, so the fact is the world is digitizing, the world will move more and more to technology. There's been a change, and I don't know whether it will, therefore IT services may not remain as people intensive. So if I'm looking at employment, it might be a different story. But to say these people will not have the business or not have the growth beyond like a small hitch in the middle, because when the consuming countries slow down, what happens often is that your sales cycle gets extended, deals don't close, they get pushed by 2 quarters or something, but doesn't mean that business will disappear. I'm not of that view at all.
Got it. Okay. And this recent uptick in global growth, which is looking resilient, could that bring about a return of discretionary spending as well, you reckon, or not necessarily?
You're talking in
global growth.
So for the technology side, yes. Some of the discretionary projects which got like kind of pushed. I'm saying eventually people have to do those. It's not like a forever thing that you'll never do that tech spend.
Got it. What does Devina Mehra like the most within this Indian landscape?
Okay, so one sector which we've been overweight a long time, which is since October 21, so 2.5 years, has been capital goods industrial machinery, which most people started talking of only in 2023. but our systems had signaled it after like 12 years as a dog sector from 2009 to 21, it turned and how. So we've been trimming, we've been changing, and I don't know whether how long this will last. So I mean, we are a lot lower than where we were, but we are still overweight that sector significantly. Right. And sometime maybe, I don't know, sometime that story will be over because a large part of the story has played out, but we are still overweight. The sectors we've been overweight from beginning of 2023 have been autos and pharma. And in this rebalance also, we have added some names there.
I was about to ask that to you because the last time we spoke before your quarterly rebalance.
Yeah. So
you're saying in the quarterly rebalance you've added auto and pharma.
We've added a little bit more in these two. We've also added in metals. So
does that make you
actually even
China
before
growth?
Our rebalance towards the end of the end of March itself, we added.
But is that a China return which prompts you to do this or something else?
I mean, the signals are there that the metal prices are firming. So, you know, for whatever, of course, China is a big player on the demand side, so that's part of the story. But you know, it is also that overall the prices are looking better. Construction would be a little overweight. I think that would be broadly where we are overweight.
Okay, sorry, just one quick follow-up, Devina, excuse me. But metals, I mean, do cycles, because you look at cycles so closely, do cycles in metals last for a very brief period, or would they be lasting? Just trying to understand that could this uptick be sustained? Yeah.
See, in commodities, you never know sustained. So, and I am not a believer in these super cycles and all of that because, again, these are just narratives. And commodities is one area where a bull market hurts a lot more people than it benefits. So it's not a bull market that everybody loves. But for now, it's looking fine. And we were very underweight also in metal. So that was also, we've added 1 or 2 cement companies also, but I don't think we'll be overweight there.
Got it. My final question is that's on the behemoth sector. I mean, BFSI, you've had very contrarian views in the past. I think you told me last time that maybe at the margin you've changed a little bit, but I'm just trying to understand BFSI.
BFSI, I'm a nervous investor in banks and lenders, as I keep repeating. People tell me that you repeat it in every interview of yours, but I said that's the truth.
I'm just trying to understand.
So I mean, we are still underweight banks quite significantly. Okay. Within banks, we are more oriented towards PSU banks. So that's the part we like better still.
Got it. Yeah, I just wanted to get that post the quarterly rebalance since I don't know the stance. I didn't know the stance then. Devina, before we wrap up. You've been a big fan of Daniel Kahneman.
Right.
God bless his soul, of course. He did wonders to us. One key learning from everything that you've read, heard, seen about him, one key learning that you've imbibed in your investing career as a result of studying his work.
He says in every field of human endeavor where judgment is involved, a system will outperform the so-called expert. So, you know, this I read afterwards, but we had already implemented. I said because human beings cannot eliminate bias, they cannot eliminate the randomness, what he calls noise in their judgment. So the only way to do it is with a system.
Okay, Devina Mehra, such a pleasure talking to you. Thank you for taking the time out and being with us today. Really appreciate this and look forward to reading your book as it gets published soon.
Thank you, Niraj. Thank you. Great being here and chatting with you.
Always a pleasure. And viewers, watch out for that book. It'll be, I'm sure it'll be a bestseller. And we'll, of course, talk about that book with Devina when it does get released. So thanks so much for tuning into this edition of The Talking Point.